Let's kick things off with inflation. The rate eased to 3% in February from 3.5% in January. But higher global oil prices are expected to lift fuel costs from April, reducing the likelihood of a near-term rate cut from the South African Reserve Bank.
Inflation was still very benign in February, exactly matching the Reserve Bank's new inflation target of 3%. This was slightly lower than expected, mainly because food prices fell more than we had factored in. This data largely predate the war on Iran, though, as well as this resulting spike in oil prices and the weakening of the rand exchange rate, both of which will be more inflationary than expected before the war. If the war is relatively short-lived, the resulting spike in fuel prices should cause a fleeting spike in inflation. But the longer oil prices stay high and or the rand stays weaker, the higher the risk that this will also result in more indirect inflation pressure that broadens beyond just fuel prices. At this stage, we expect the Reserve Bank to sound hawkish about the inflationary risks brought about by the war, but for now, we expect this to merely delay the interest rate cuts that we previously expected. But the situation remains very fluid, and the inflation and interest rate impact will ultimately depend on whether the war escalates and how long it continues.